Welcome to The Explainer. Today, we're jumping into the world of investing, especially for the absolute beginner. We're going to give you a simple framework that'll turn that hesitation into a confident first step.
All right, so let's just dive right in. I think to really get started, we've got to talk about the number one thing that stops most people dead in their tracks before they even begin. Any guesses what that is?
Yeah, it's the fear of losing money. And look, if that's you, you are definitely not alone. It is a completely valid fear, right? I mean, it's grounded in reality. The market can be a pretty scary place. And let's be honest, big losses are a real possibility.
I mean, just take a look at this. To put it in perspective, if you had invested, say, $100,000 back in March of 2008, well, just 1 year later, thanks to the financial crisis, that investment would have been worth only $52,000. That's a staggering 48% loss. I mean, a number like that is enough to make anyone want to just stuff their cash under the mattress and call it a day.
So, when you see a loss like that, what's your first instinct? It's the panic, right? You want to sell, stop the bleeding, but the problem is doing that just locks in that loss forever. But there's this old saying in investing, time in the market beats timing the market, and it kind of hints at a much more powerful strategy. So what if there was a better way to think about all this?
Well, there is. And the solution? It's not some crazy, complex trading algorithm. You don't need to be a math genius. It's actually a pretty simple framework built on 3 foundational principles. You can think of them as the 3 secrets to investing. And they're all designed to lower your risk and really put the odds in your favor for the long haul.
Okay, secret number 1, and honestly, this is the most powerful one of all, time. Let's go back to that scary example, right? That $100,000 from 2008? So instead of panic selling, what if you did nothing? What if you just held on for 10 years? Well, by 2018, that same investment would have grown to over $252,000. You didn't have to do a single thing except let time work its magic, smoothing out all those terrifying bumps and letting your money do its compounding thing.
All right, secret number 2 is a classic, and you've probably heard it before, diversification. You know the saying, don't put all your eggs in one basket? It's that simple, but it's brilliant. The whole idea is that if one part of your investment portfolio is having a bad day, or heck, even a bad year, your other investments are there to cushion the blow and keep the whole thing stable. So what does that actually look like? Well, instead of betting your entire future on, say, one single company's stock, you spread your money across different types of investments. We call them asset classes. This chart here is a super simple example. You're splitting your money between stocks, bonds, and maybe some alternatives. See? You're not relying on any single one of them to make or break you. And that brings us to our final secret, liquidity. Think of this as your financial defense system, your safety net. It's all about having cash ready to go for those oh-no moments in life, a sudden job loss, an unexpected medical bill. Having that cash means you are never, ever forced to sell your long-term investments at the absolute worst possible time just to cover an emergency. And this is so important. So remember this. Before you invest a single dollar into the market, you need an emergency fund. Seriously, this isn't just a suggestion. It is a non-negotiable prerequisite. This is the thing that protects your entire investment strategy. It's what allows you to stay in the market long enough for that first secret, time, to actually do its work. Okay, so we've got our 3 secrets: time, diversification, and liquidity. With that foundation in place, let's look at how they help us deal with the core trade-off of all investing, the relationship between risk and reward. You know, it's kind of like what they say in the movies, with great power comes great responsibility. Well, in investing, with great risk comes the potential for great reward. Assets like cash, they're super safe, but they're not going to grow much. On the other hand, things like stocks can be a real roller coaster, but they offer much higher potential returns over time. And this chart, I think this is really interesting because it just visualizes that trade-off so clearly. If you look back historically, if you wanted those higher returns that stocks have offered, we're talking around 9% on average, you had to be willing to accept more risk and more ups and downs than you would with safer things like bonds or cash. As they say, there's no free lunch. And all of this leads to maybe the most important question you have to answer for yourself. How much risk are you actually comfortable with? And your personal risk tolerance, it is everything. You want to know why? Because the biggest, most catastrophic financial disasters happen when people take on way more risk than they can stomach, get totally freaked out, and, you guessed it, they panic sell right at the bottom. Okay, so how do we take this idea of risk tolerance and turn it into a real-world plan? Let's get super practical.
We're going to look at how a simple portfolio might change and evolve based on your age and your stage in life.
So let's say you're in your 20s. You have the single greatest asset an investor can have: time. We're talking decades, right? This super long time horizon means you can afford to be more aggressive. You can take on more risk to chase higher growth because, hey, you've got plenty of time to recover from any market downturns along the way.
Now, fast forward a bit. As you move into your 30s, life might start to look a little different. Maybe you're saving for a house, maybe starting a family. Your priorities start to shift a little bit more towards stability, so your portfolio reflects that. It becomes more balanced, you dial back the risk just a notch while still aiming for solid growth.
In this slide, I think just brilliantly illustrates that final shift. When you're nearing retirement, your goal is no longer about aggressive growth. It's all about preserving the money you've worked so hard to save and generating a nice, stable income. So the portfolio gets way more conservative, prioritizing safety over those big, high-flying returns.
So what are these portfolios actually made of? Well, they're all built with just a few basic components. You've got stocks, which give you ownership in a company and that potential for growth. You've got bonds, which are basically loans that provide stability. And then, for most beginners, the absolute simplest way to get that instant diversification we talked about is through something called an exchange-traded fund, or ETF. Just think of an ETF as a pre-packaged basket that holds hundreds of different stocks or bonds. So when you buy just one share of an ETF, say one that tracks the whole S&P 500, you're instantly buying a tiny piece of all 500 of the largest US companies. Bam! Powerful diversification in a single click.
Okay, making that first investment, that's a huge milestone, for sure. But it is not the finish line. Investing isn't something you just set and forget forever. It's really the beginning of an ongoing but simple process.
So over time, your portfolio is naturally going to drift away from your target. Let's say stocks have a fantastic year. Well, that means they'll grow to be a bigger piece of your portfolio pie than you originally intended. And that's where something called rebalancing comes in. It's just the process of trimming things back to get them into alignment with your original plan.
Now, rebalancing might sound super technical and scary, but it's actually really simple. About once a year or so, you just check in, you see how things have shifted, and you make a few small adjustments. It's basically a disciplined way to sell high and buy low, and it makes sure your portfolio continues to reflect your goals and your risk tolerance, not just what the market's been doing lately.
So what's the big takeaway from all this? It's that you absolutely do not need to be a Wall Street genius to be a successful investor. Not at all. Investing is a journey of continuous learning and making small, consistent actions over time. It's not some frantic search for perfection. Really, the most important thing is simply to get started. You know, we started this whole conversation with that very real fear of losing money. But now you have a framework. You've got the 3 secrets: time, diversification, and liquidity. You understand that core trade-off between risk and reward, and you have an idea of how to build and maintain a portfolio that actually fits you. So, you have the map. The only question left is, where will your journey begin?